following is an introduction to venture capital. To begin, we will look at exactly what venture capital is and why businesses will use it. To begin, what is venture capital? Venture capital is the capital provided by venture capitalists to startups, small to mid-sized companies, and businesses looking to expand. Basically, venture capital firms provide the capital to growing businesses and startups that the venture capitalist believes has an upside or high growth potential. Startups and small businesses often require capital to expand into new markets, to develop and improve their products and services, to meet other financing needs. Additionally, venture capital firms in this sense fill a void by investing in these firms because due to their small size and limited operating history, they cannot look to the capital markets for financing and cannot issue debt. Venture capital firms will provide the capital to those entrepreneurs and startups, but for a price. This leads to our next slide. What's the catch? Venture capital firms take on significant risk by investing in often unproven businesses, many of which do not provide strong returns on the investment, if any at all, and some end up going bankrupt. To make up for the possibility of one or even most ventures proving unprofitable, venture capital firms will often secure preferred terms on their investments, most commonly by securing a portion of the equity. Additionally, venture capital firms operate under the assumption that some of these investments will fail, but there is a chance that at least one will be a home run, meaning that the venture capital firm will make a huge return on the investment. For this, think Facebook or Google. To continue, a big payoff. Why do venture capital firms get such a huge return? In the event that an investment pays off, it often pays off big by earning a long-term rate of return well above the returns in the general stock market. Think of those success stories like the venture capitalists that got in on the ground floor of Facebook before the IPO, or Google. Those investors were handsomely rewarded for the faith in a new technology becoming a strong business. There are three main reasons for venture capital firms to demand a big reward for their investment. The first one is no liquidity. Unlike an investor in a publicly traded company, venture capital firms have little to no way to trade their interest in a company with another investor. Although there is the possibility that you could trade with other venture capitalists, but for the most part, a venture capitalist is stuck with a lack of liquidity, and that deserves a reward for taking that type of risk. Second, there is little diversification. Much of the venture capital activity in the world takes place in the technology, biotechnology, and telecommunication sectors. While there are venture capital funds that invest in any number of other sectors and industries, much of the activity is concentrated in technology. While this has been great in helping produce big innovative successes like Google or Twitter, venture capital firms take on a lot of risk in such low diversification. Lastly, the most obvious reason for demanding a sizable payout in preferred terms is that the venture capital firms take on significant risk. Even more than other private equity investments, venture capitalists are operating under the mindset that the investment may very well turn out to be a flop, but nevertheless, they make the investment because they hope to make up for possible losses with even bigger gains. Limited partners in the funds also accept this risk, but expect the general partner to mitigate it as much as possible. So, in conclusion, venture capital is a source of funding for startups, entrepreneurs, and expanding businesses. Venture capital is high risk, high reward. And while many venture capitalists have struck out on investments, there are a lucky, smart few who have been a big part in developing the next big company.